Ira Epstein of Linn Associates with your financial market wrap-up. And this wrap-up is for Tuesday, and we're now on the 14th of April, 2020, about 5:35 p.m. And normally I'd say, well, tomorrow's tax day, but it's not really. For some, they could file, but we all have much longer, a couple of months yet before we have to do that. What is interesting is how the markets have come back, especially in the stock indices. We've approached in many of the indices a 50% correction. The market had trouble at a 38% mark. It's gone on to the 50% mark. If it goes much higher, traders will say, that low we made in March, we're not testing it again. We might come and backtrack, but the odds of getting through it are small. On the other hand, we get unemployment numbers this week. The early estimates are for another 5.5 million to hit the rolls. That means we'll be up to nearly, 22 million people on the unemployment rolls. I mean, if you look at things, there's good, there's bad. The question is, when do we get out of all this, and how do we get out of all of it? There's going to be a lot that has to be discussed. The good news is it's only mid-April. Nobody's saying that they're opening tomorrow in America. There's real good news in Europe. They're opening up already car plants. So I saw Czechoslovakia, I think in Germany they're opening one. There's one other country that they're opening. So they're starting slowly to reopen, and this is good news. And of course in China, they're claiming the factories are back to 75% operation, and that companies like Foxconn, they're running as much as they can to get the new iPhone, well, not the brand new iPhone, but iPhones out, and iPhone is still going to be coming out with other items there. So we can look tonight and we see that these market numbers have come back, and they've come back in a dramatic fashion. Even the bears have to say this has been one heck of a bounce. In the gold market, the one thing I keep noticing is if you buy these sharp $40, $50 rallies, the market seems to let you come in at a lower level to not do that. Will it continue? I don't know. I don't hold a crystal ball to the future, but I'm an observer, and I'm a good one, and I watch that really hard. In the dollar index, still under pressure as we're just waffling, but that market's sinking back. Bonds and notes stabilizing, and I think stable's a real good thing to get right now. We bouncing tonight in the energies. They lost quite a bit of ground today. The Texas Railroad Commission is hearing the appeal of different parts. I think there's 55 people talking before them. There was 5 hours of testimony today. Should they put caps on production? Shouldn't they? The big boys, the Marathons and the others are saying, why are you doing that? The market's taking care of it, which is true. In Oklahoma, now there's a petition, and it looks like there'll be a May 11th hearing to see what that state wants to do, but they'll be looking and seeing what Texas does first. Gasoline prices up a bit here. So when we look at the S&P, we've come off this low close, and this is a weekly chart close of 24,037, and we've come up approximately 400 points. That's a heck of a rally. So the market's in that 38, 50% range as it's coming up on a close-only chart. When I step over and I show you the numbers on the chart, this is 50% on a daily bar chart. And they're a bit different. Remember, this is closes only, and this shows the highs and lows. It's very different. But you're in this range. Could you get up to the 62%? Yes. But then telling me you're just going to come back down and get here, that's going to be a harder argument for the bears. I believe that. So we're at a point where I thought at first if it stopped here, you were going to come down and challenge these lows. I don't know anymore. Now I'm questioning it. The market's euphoric about getting people back to work, getting people off the payroll, the unemployment rolls, and back onto the payrolls. We'll see. I would feel super euphoric and say this market can go for highs if we were to find a vaccine. I know we're hard at work on it, but we at least need tests to the point where you can go somewhere and eat. I don't care if you go to a restaurant and they test you. It's got to be where we can get something back where you feel safe, and then new seating arrangements. I was listening tonight as they were talking, maybe disposable menus. Why not? Something like that could work. When you're coming into the swing line part, you see that you've been, this is not a surprise, higher lows, higher highs, and until you take out 26, 20, 75, the bulls have control of the market. The market's also been over the 18-day average, and when you cleared this area, the bullishness began, and it's kicked itself up. What about resistance points? Well, you've run against the upper Bollinger Band. You see this line? That's called a Bollinger Band. It's an algorithm designed to keep the market trading within it 95% of the time. It's not making life easy for those that want to be bearish, because instead of going sideways, the band has got an arc to it that's pointing up, and it could lead into this resistance of the 200 and the 100-day average. But then I think the bears have a real hard case saying that you're going back down here. I'm telling you, I changed my opinion when we cleared the 38% level, and at 50, I'm going, At 62, no, I don't think you're going back to those lows. So that's a different opinion that I'm offering you. In momentum, you embedded. Now, embedded means you converted from an overbought condition and locked in momentum. It occurs when the two numbers that make up the slow stochastic, they're called a K and a D line. Don't ask me why, I don't know. Was I a good friend with George Lane who developed this? You betcha. I used to have a TV show, Stocks, Options, and Futures, and from the Joe Granvilles, the Robert Prechters, John Bollinger. I had them all on my show. I got signed books by everybody on these things. And I would ask them questions. Then I'd call them up and go, I love this indicator. Tell me this part and that part. And they'd share, and then I'd go, well, I found something different. But that's how you worked with it. So why he called it a stochastic, because I don't even know what that is. There's a fast one, a slow one. That I understand. I understand the math as to how they work. And how these two lines, the blue and the red, really work is one, it's the same formula. The red uses 3 days worth of value. Now, if you put it on a 15-minute chart, it'd be 3 15-minute time frames. The blue uses 5. Now, you can decide you want to use a 14-period look back, which is like using a 14-day average, an 18. You play with that till you come to what you want it to be. But I am seeing that this is embedded, which means it's converted itself from overbought, and I consider any readings that are over 70 on either side of the number overbought. When both get over 80 for 3 days in a row, they're locked in. And when the red closes back under 80, it's a warning sign that the momentum has been lost. The market might be ready to then challenge back to what I call this line in the sand, that 18-day moving average of closes. In the NASDAQ, an embedded reading. Now, you cleared the 200-day average. If we take a look at this, here's the 200-day. We had been fighting there, and I made good mention of it. And I said just yesterday, if the market rallies, I'm looking for resistance between the 200-day and the upper Bollinger Band. You went there today. Remember, this was how the market looked yesterday. And when the market reopens, it's going to look different. Well, that's how you looked, and this is how you're looking tonight. So the market even cleared the 100-day. The FANG stocks, simply put, are on fire. Did you look at the price of Tesla? I mean, just take a look at what's going on in this. Amazon's at a new all-time high. Netflix on fire. So you've got these markets that make that up, and when you get those FANGs going, believe me, folks, things start moving on it. When you take a look at the Dow, the Dow's got the embedded reading too. Now, this is a different index, obviously. First of all, it doesn't look anywhere near as bullish as the NASDAQ. This is made up of the old-time companies. You know that, it's 30 of them. And it's a little bit different. It's lumbering along. It too has resistance up here. The 200-day average, if you can see, it's in the gray right there, and there's the green. So a lot of resistance above the market. But if you get up to those numbers, you're going to need another event to get down to those lows. So how fast did that happen, and is that it? It'll teach me something, I'll tell you that, because normally I as a market technician would be looking for tests of those. The Russell, nah, it's one of those that's having great trouble. This one could still come back here. It's the only one I could say that on. The chart picture on the others are getting stronger than I thought they were going to be. Here's another factor that's got me questioning my bearishness that I had earlier and why I'm shifting gears. You've brought this back to norm. You're at 37. You do realize you were at 85s up here in the reading. You're back to a 37. You're going to need some event that I don't see out there. Example, another wave of COVID-19 hitting China, hitting Europe, saying, uh-oh, just when we thought we were clear, we weren't. That would do the job. But right now, that isn't the case. So this market's taking out all that fear. And as that's happening, what's going to make the market reverse back to those lows? So I have to, that's what the part of being a chartist is. You don't get locked into any one idea. In the bond market, lower highs, lower lows. Is the market going to be able to get to the lower Bollinger Band? It just might. But if we think about it, since that panic of March, when you first got up to the crazy rates and then you immediately corrected, you haven't hit a Bollinger Band in a while. I don't have any opinion as to why it should right now. I think it's more of a drifting market. When I come to the 10-year notes, the 10-year is riding, and I think you'd agree with me, this 18-day average of closes. So the market is now saying to itself, okay, I found a home. And I teach you that that home is often that 18-day average. It's the line in the sand, the difference between bullish and bearish. When the market's over it, I have a bullish bias. Under it, I have a bearish bias. And you've got discrepancy in this market. Momentum has been down, and it's taken this market down. When you hit this 18-day average, you went into a neutral picture. Now, as of my writing to you or recording this, you had an outside day up today. Therefore, I'm going to say that the swing line is up from here. So I've had the period of higher lows, higher highs. I think the bulls are controlling it, but get under 137.27? No, I don't think that anymore. In fact, if that occurred, I think you're going to go to the lower Bollinger Band, because when you take out the low of an outside day up, this is my own rule. It doesn't mean it works, but I've gone back and done a lot of these. When you take out the low of an outside day up, it's a trap. An outside day, you're often trying to catch people out of sync and going to try to advance the market in another direction. Take that low out, and my theory, it's just a theory, is that price will then drift to the closest main moving average, well, under the market it's here, or the closest of what? A Bollinger Band, which is right here. So that would tell me that the market wants to drop back to the 136.31. I mean, that's still a good move, so we'll see if that happens. But right now I'm in the bull camp. In the dollar index, still in the bear camp. The market peaked out. Now you've got a trend with lower highs, lower lows. Supports all the way back at 97.87. And I'm the very first to say you're in oversold condition and not trying to lock that in by embedding. So little caution there. Eurocurrency in an uptrend, and it's pretty interesting. It did not get itself in any manner overbought. I see the resistance between the market of 111.18 to 111, 61, right in this area. Support back at the 18-day average of closes. I think the bulls have control of this market. Japanese yen, I don't see anybody having control. I see a pattern of a higher high and a lower low. I don't see anyone controlling this. The market's become quickly overbought. Just nothing going on there, whipsaws. In June, Bitcoin. Now, April's still the lead month, so remember that. But for all purposes, I'm already watching the June. I'm paying close attention to this 18-day average of closes. I see a market void of a trend and starting to just drift sideways. You can already see the Bollinger patterns were wider, and now they're narrowing in just like that, which tells you that price compression is happening. In other words, volatility has come out of the market. Then we get over to the Brent versus WTI crude, the June contracts. And the market's bouncing. It's about a $2.40 difference. That'll be Brent over WTI. And where did the market fall today, and where is it finding support? Right here at the 18-day average. Now, if you saw the API numbers at the end of the day, they're obviously quite bearish. Just in the crude alone, you have almost 12 million barrels built. And the U.S. is talking they want to buy 23 million barrels for the strategic reserves. Fine. But that's 2 weeks production, the way that we've gone over the past 2 weeks of builds. Understand what we're dealing with there. Are we trending in WTI? No, you're not in Brent either. You got higher highs, lower lows, and you've pulled right back to the neutral zone. What about gasoline? This is the market that's been trying to sneak up on it. Remember I was just talking a moment ago how you get into these Bollinger Bands and they start forming these tunnels. That's very common. And from that, it's like a spring in a tunnel. It keeps winding itself till it can break out. What you often get in the first leg of it is false moves. You get up to that Bollinger top, you're counting on it to break out, and it disappoints you. It goes back and forth as prices winding and building power. The bulls have control, it's hit upside targets, and you're in a resistance area with an overbought market. If we get all these reductions, forget the Texas Railroad Commission or the Oklahoma commissions, let's assume the marketplace does it, and we start taking off oil. Well, that's going to mean a lot less natural gas. That's a byproduct. Right now, all they do is burn it into the atmosphere. Get rid of all that, the environmentalists are going to be happy, but you're going to change the picture of supply versus demand. We have demand coming in natural gas. It doesn't matter what anybody tells you. Here's why. Summer's coming, it's going to get hot, and people are going to turn on their air conditioners, whether they're in their offices, whether they're in their homes, whether they're unemployed or employed. And when that happens, you're going to get new demand. So you've got to start building that into your thinking in this market. Are we trending right now? No, you're in a whipsaw, a huge decline, a radical move back up, and pulling right back to that 18-day average, trying to figure out where you're at. Speaking of where we're at, I want to show you something we're doing. I know you're watching me for the financial videos. I don't know if you're aware that I put out a Spider ETF video each day at 4 p.m. for subscribers only. And the idea here is, if you're like me, you're always second-guessing yourself. My thing is, I'm disciplined. I might be able to give you the chart confidence you need to get some ideas there. So at 4 o'clock, approximately each day, I do a video on 27 Spider ETF markets. It'll look like this. There's more studies than you're seeing here. The idea is I'm going to give you a touch of the fundamentals. We already know what they are. Talk about what tomorrow's going to offer. Entry points, exit points, what to do. Maybe that just gives you the things that you're looking for. Now you might say, what markets am I going to cover? All the major spiders. Then I'm going to cover the stock indices, GLD, GDX, the silver, the interest rates. I'll cover 3 major currencies, giving you a picture as to what it is. If you'd like to see this, it's really simple to do so. $8.95 for 30 days. I don't think that's overcharging anyone for that. After that, it's $16 for every 30 days. How do you get it? Go to our website. Under the word research, you'll see Ira Spider ETF video. It's all right there. It'll take care of everything you need, and you can sign up. I'm Ira. You have a great day. I will see you all tomorrow.